Hello, welcome to this week's Market Carver. Adam is out of the office working on all of the thirdly presentations that hopefully you're able to join us with at your location. This week I'm joined by Zach, who is going to be talking to us about some leverage loans, and I'm going to be diving into looking at just how few stocks are actually down this year from their 6-month highs. And so that's the first slide we're going to look at this week. The chart you're seeing on your screens right now is going back to the 1990s, and what we're looking at is the number of stocks that over the last 6 months have declined by 10% or sitting on a 10% loss is maybe another way to look at it. And we're sitting on very few. One topic we've been discussing throughout the Market Carver and in our allocation meetings each week is how the markets continue to improve its breadth, its participation, the gains that we're seeing beyond just the handful that really were driving the market higher at the start of the year. And that's really improved in March to the point where now we have less than 14% of the S&P 500 is down over 10%. And as you can see on this chart, looking longer term, that we don't really get a lot lower than this. There's always some degree, there's some stock, a handful of stocks that are seeing some type of weakness for obviously variable reasons. But right now we have a lot of stocks are continuing to move higher. In fact, as we closed out the first quarter, the average stock in the S&P 500 was up just over 8%, just under what the overall index was doing. And so this is very encouraging. The take home message from this type of data and what we see is typically this type of data, this look at the drawdown for individual stocks, this type of data begins to bottom ahead of the market peaking out. So as we saw looking at the great financial crisis in '07, that this peaked several months, or this bottomed at 11.7%, several months before the market actually peaked out. And we've seen that several times before major market highs, that we start seeing stocks begin to decline by 10%. In fact, looking at '07, we had over 40% of the market was in a double-digit correction by the time the S&P 500 index itself finally peaked, and we saw the repercussions of that in 2008. So the fact that we're seeing very few stocks down right now is encouraging. It's telling us that we do have broad participation. It's when this data starts to change, if we start seeing the market going higher, but we start seeing 20, 30, 40% of stocks are starting to experience declines, that's when we start to get a little bit more concerned. We're not seeing that today, so that's a positive sign for the market right now. And of course, this is something that we're monitoring every single week to see if this data does start to turn around and become more cautionary. But right now, it's very encouraging that we have very few stocks, like I said, under 14% are actually down double digits right now. We're starting to see good participation as we move into the second quarter. So again, another good piece of information, more bullishness kind of for the market. We are seeing things that are a little bit stretched. We've talked about in the past where the market is short term getting a little overheated. But when we're looking longer term, which is what this data is looking at, very positive and encouraging sign for the current uptrend. Now I'm going to toss it to Zach, who's going to shift us now looking more towards a fixed income market, looking at some of the leveraged loan data.
Yeah, so we'll talk a little bit about leveraged loans, particularly CLOs or collateralized loan obligations. Essentially, they're just pools of these leveraged loans. And this conversation will be particularly relevant to those of you who have fixed income allocations inside your portfolio, as we hold two separate funds in the CLO space, JAAA and JBBB. The prevailing narrative is that defaults are starting to tick up, which is true. And that may lead to you hearing some negativity around CLOs. So we just wanted to provide this chart to give some context. It's a fairly complicated one, so we'll try and break it down a little bit or simplify it. What I want you to focus on here is the black bars, the small black bars along the bottom of the chart. These are real losses experienced by default or via defaults inside these CLOs. And so if you focus on the center of the chart there, December 2008 to December 2009, during the great financial crisis, you can see that in a time of massive default, where defaults were incredibly high, they still did not reach that triple or double B rather credit support line. You can see the triple B is higher, and then triple A all the way up at the top. The simplest way to think about this is that if these black bars were to reach the credit support lines, that could be interpreted as this tranche or this level of credit rating CLO is now being impacted, and the holders of those are realizing losses. Currently, J triple B, the lower rated of the two that we hold, is yielding about 9%. J triple A is yielding about 7%, both of which are very significant given the type of yield that you can receive in other fixed income investments with similar credit ratings. For reference, high yield, which by definition is double B rated or lower, is yielding about between 7 and 8% right now. And so to get 7 at triple A rated credit, or to get 9 at double or triple B rated credit, which is still considered investment grade, is fairly significant. And the take home message here really is that it would take default losses far greater than what we experienced in the great financial crisis before these CLOs are materially impacted and investors realize losses. So if you start to hear some negativity around CLOs as default rates start ticking up, some negative sentiment there, rest assured that it would take a type of default loss that we have not experienced, at least in recent memory, for those to be threatened.
All right, thank you, Zach. And that's it for this week. We hope you're able to. We hope you enjoyed these looking some of the fixed income markets and equity markets. Again, we're getting into Thirdly season. We hope you're able to join us at one of the several Thirdlies going on with Adam and Joe and Aaron presenting on some very interesting topics. Hope to see many of you there. And again, we'll be here next week with another Market Carver. If you'd like to schedule a meeting, we have the QR code on your screens right now and a phone number. Our team would be more than happy to discuss and talk with you and set an appointment time to meet in the near future. So please use the QR codes and the phone number there on your screens. Until next week, have a great weekend. Bye.